Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today I'm pleased to welcome another expert I haven't had on the podcast before, but who is also no stranger to Money Show events over the years. She's Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Nancy, how are you?
I'm great, Mike. Thanks for having me.
Thank you for being here. This has really been a kind of a fascinating year for markets, and I'd even say a fascinating couple of weeks here. Big tech's been dominating the market through the first half of 2024. And then we saw a sharp correction in those names, and then what I guess I'm calling the unrotation correction after that. A lot of volatility of people kind of going from one side of the boat to the other. What do you think's driving that?
I think it's pretty much the algos and the hedge fund guys. I was in New York last week, and somebody asked me about, when is Nvidia going to correct? And it didn't totally, well, it did correct actually, but I said when the Hedgies go to the Hamptons, because they drive the short-term swings in volatility, which can be the friend of a long-term investor. We always use the volatility to add to names we want to own.
Got it. Let's talk about tech then, big picture. Step back a little bit at the short term and look at the longer term. I know you've been a big advocate of the sector. You've talked about some of the promising names there. Are you still on board with that? And if so, what do you see as the evolving outlook for that sector as we go into the back half of the year?
Well, I think when I was in at the Money Show in December, I gave a speech on the fourth industrial revolution and how to have it benefit your portfolio. And in that, I shared with the audience something that I have been arguing, I guess you could say, for the last year, which is this market and this economy is analogous to the 1990s. Now, it isn't 100% perfect fit, but I was managing money in the 1990s, and there are a lot of similarities, higher than average inflation. So in the 90s, it was above 3% for the whole decade. 10-year floated between 5 and 7%, which is, much higher than it is now. We had a labor shortage and a lot of spending on technology that drove productivity fueled growth. So we think that you are still going to be able, that we're early stages in this generative AI super cycle, and that you can still make a great deal of money. You just have to be patient, and you have to not let the market scare you out of stocks, as the great Peter Lynch said.
Got it. And I think one of your interesting points that I always found was that, you've got some of the obvious technology names, but it's also how technology is finding its way into other parts of the economy and other sectors, right?
Yeah, exactly. So our investing theme for the last 2 years has been old economy companies that are embracing, first it was digitization and cloud computing, and now you add in generative AI and generative AI cloud computing. And what you see is improving margins and a lot of growth in not just the top line, but also the bottom line. So think of a company like Walmart that's embraced all of them, plus robotics in their stores, and you can take it through the industrials. A lot of the names that we own in the industrial space are either automating factories or figuring out ways to improve productivity within factories. And so this is our theme, and it carries through to financials. American Express uses generative AI to improve fraud detection. So there's a lot of ways that this is spreading through, and that's really reflected in the names that we hold in our portfolios and in our ETF, TGLR.
God, I'm glad you brought that up, because I know a lot of people want to think it's just kind of this sort of, this sort of fancy term you throw out, AI this, AI that, but companies really are using the technology to do more behind the scenes. It's not just sort of like a throwaway term, right?
That's right. And I think there's a lot of people coming out, and saying, well, this is a bubble. It's not even close to a bubble. The valuations in technology do not rival what we saw with the four horsemen in the 90s. And even the former CEO of Cisco, John Chambers, that stock was trading at 100 times, remember, at the end of the decade. He's come out and said that generative AI is bigger than the internet and cloud computing combined. So you will find that the use cases are going to increase. The Apple WWDC, the developers conference, was instructive in how we're going to see improvements in our handhelds, smartphones. And I think you're just going to continue to see it expand. Retail was easy, financials, but healthcare is another place that generative AI is improving productivity. And I'm sure I could find many use cases in energy and materials as well.
Four horsemen, there's a term I haven't heard in a while, but it does take me back. Let's talk a little bit about market concentration. I love the commentaries that you send out, a lot of great information for people to read there. And one of the things you noted was, okay, big tech, yes, there's this concentration to some extent, but it's really not all that bad in the US compared to what's happening in other global markets, right?
That's right. So if you look at sort of the developed markets, so the DAX and the CAC and the FTSE, we are significantly less concentrated than those indexes. I think I can't remember it off the top of my head, but one of them had a concentration of 60% of the top 10 holdings, and their holdings, their underlying markets, are much less growthy than ours. So when you add that back in, I'm not really concerned about concentration risk. I think you can continue to see these names expand their market share and their growth, and they can continue to perform well in the stock prices.
Got it. That said, let's briefly talk about market breadth, I guess, and cap domination. I mean, I look at, what's happening in the Russell, and you sort of look at the top 200 companies versus the mid-tier and the small caps. I mean, the performance divergence really is pretty extreme. Do you think that's going to stick with us? Is there any worry from that? Or is that just, part of the winners get bigger and the rest, it is what it is?
Well, that's such a good question, Mike. I think one of the things that the market misunderstood was that the initial knee-jerk reaction that was that higher interest rates were going to be bad for long duration stocks like technology. But these stocks that we own anyway, the very largest of the technology companies, they have earnings and they have fortress balance sheets. So their interest income has exploded. At Meta, it was 3 times growth. At Google, it was 170%, I think. At Microsoft, it's almost tripled. And so the unintended consequence of higher interest rates is that the big companies did get bigger and the small caps got smacked around. So when we finally get to an environment where the Fed is cutting interest rates, I don't think that's going to be bad for technology, but I think that will help broaden out the performance among the different cap weightings.
Yeah, okay. And I know I'm going to get to your conference topic in a minute, because I think you'll probably touch upon that. But let's briefly talk about the economy here. How do you stand on the growth outlook? I know you were on CNBC the other day and talked about how the job market might be a little bit weaker than the Fed actually thinks.
I think so. I'm worried about the low-end consumer. That's for sure. The job market does seem to be weakening. We had in March, that's the last number I had, we had 275,000 fewer full-time jobs. Part-time jobs went up month over month, year over year, and the average hourly earnings went down. And so when you look at the affordability, for example, of a non-managerial worker, his mortgage, he has to work 71 and a half hours to pay his mortgage. That's the highest it's been since 1991, except for a little blip in October of last year. So that is going to press in on the low-end consumer. And I think that's just something we're watching. We've seen a slowdown in the manufacturing PMIs that we just haven't been able to dig our way out of, and leading economic indicators. I think that's partially because we're moving to a digital economy, but we are watching those things. And, we had the same problem during sort of spurts within the 1990s. And so the Fed is going to have to, pay very close attention, and I think be willing to maybe not be so data dependent, which is backward looking, and be more in the forecasting business.
Gotcha. Some of the people that you've been on stage with are obviously talked to, Jim Bianco, for instance, and Kenny Polcari and so on. There's a big wide range of opinions on Fed policy, the none, 1, 2, 3, whatever number of cuts maybe in the next 6 to 12 months. Anything you want to add on that? Like, where do you come down on that spectrum?
Yeah, I don't think it matters at all. In the 90s, we raised rates very aggressively in 1994. That was Chairman Greenspan. And then we had 2 cuts in 95 and 1 in 96. And then remember, he was talking about irrational exuberance at the end of December of 1996, and the market continued to accelerate. NASDAQ was up almost over 200% from then. So this parlor game of whether they're going to, I don't think they know what they're going to do, and they keep flip-flopping. So I think what the market is starting to do is pay attention to earnings, which it should, because that's what stocks trade on, and let the Fed alone. And again, as I pointed out, in the 90s, we had a 10-year treasury between 5 and 7%. So I don't play that game, because it's a loser's game, if you ask me.
Gotcha. Fair enough. We obviously talked about tech already, industrials, any other groups? I know earlier this year you were kind of talking a little bit about consumer discretionary and energy.
Yeah, we're still overweight energy, and we've reconfigured our consumer discretionary holdings and reduced them somewhat. There have been some big disappointments in consumer discretionary in our growth portfolio. Lululemon is an example, and in our dividend growth strategy, Starbucks. And so we've pared some of that back. We got out of Lulu and we doubled down in other places. And I think we still like communication services. So Spotify and Google are big holdings for us, and we've done quite well with those. We think Google's going to continue to do well. So that's really where we're focused on our overweights. We're market weight healthcare. I know there's a lot of people out there that like healthcare. I don't hate it. I'm just not one that's uber enthusiastic about it at this point.
Gotcha. Well, Nancy, before I get to kind of your topic in Las Vegas, I mean, you've had a long, obviously, career in this industry. You wrote the Women's Guide to Successful Investing back in 23, the second version there. Any thoughts or anything you'd want to share in terms of general advice for, that you had in the book that you think really applies to this market environment today?
Well, I write a lot of case studies in the book, stocks and people. And so the things I've learned from really wealthy people that I've managed money for, and some not so wealthy people. And then also what happens when you buy a stock and it goes down a lot if it's a great company. And so one of the examples I use is, I think the title is When Starbucks Got Roasted, I Bought It. And what happened after that, and how long you can go, sometimes years, without seeing the results. But eventually the big companies figure it out. They either buy their competitors or they find ways to solve the problem because they can. And so I think investors would be wise to mute maybe mute the TV when you're getting all this chaotic, back and forth between people like me, and just buy companies that great companies, and it's never too late. One of the case studies is a woman that didn't start investing until she was on a retirement income, and she died with $5 million. So there's a lot of that kind of wisdom in there, and real life examples.
Excellent. Well, before we wrap things up, I mean, you're going to be joining us for the Money Show Masters Symposium in Las Vegas. The official title, and I know these things always have to be given early, so sometimes depending on what the market does, they can change. But you were going to be talking about how to invest in a higher for longer interest rate environment. Based on what you've already told me, that probably has not changed. And I'm curious, just any tidbits you might be able to share that would encourage people to show up there and maybe hear the whole story.
Yeah, well, so Mike, I haven't written it yet, but but I think that what I'll be focused on are some of the myths, and then some of the historical ways that you can make money in this environment. And one of the recent examples that I saw was a divergence between enthusiasm and PEs, and that's another similarity that we have to the 90s, where these things can distort for a very long time. And so you want to pick your spots, and then in some cases you're going to have to be nimble. And so I'm going to talk a little bit about that. But generally speaking, I'm a long-term investor. I've owned Apple for 13 years. That's when we find a company we love, we hang on to it. So that's that will also be a topic that I'll be addressing.
Great. Well, I really did enjoy what you had to say back in Sarasota in December, and I think people are going to get a lot out of hearing from you in August at the Symposium. Anybody watching, just so you know, Nancy will be joining us for that Money Show Symposium. It goes from August 1st to 3rd at the Paris Las Vegas Resort. You can find out more by clicking the link in the description below. Nancy, thank you so much for taking some time out to share your insights.
Thank you, Mike. Thanks so much.